Mahesh Patil, a co-chief investment officer with Birla Sun Life MF joins us. Mahesh, just when it appeared that Indian markets were looking slightly rusty and listless, we are in a sweet spot.
Yeah, that's true. I think what we've seen is that there was some concern emerging from the global front, and there was an expectation, you could see some correction after the sharp rally, and the quarterly numbers, what we saw in which came in for the month of for June ending, for the first quarter of this fiscal year, was kind of a mixed bag. Certain companies disappointed, especially companies in the banking and some of the domestic cyclical sectors. But I think the global environment, especially the geopolitical risks, especially from Iraq and Ukraine, are kind of abating, and that's the reason why we've seen the fresh flow of money coming in. And even the US Treasury yields also have come down sharply. So I think the liquidity flows still continues to move in, and that's what is keeping the market higher. I think some concerns also coming in that monsoons, would probably spike up inflation. But some of the late monsoons which has come in has been slightly encouraging, though I think the deficit in rainfall would be around 17%. That's what is expected. And the sowing also is lower by around 7% or so. But all in all, I think the other macro numbers are still looking good. Oil is come down again to $102. That's good news, especially looking at subsidy burden. So under recovery on diesel now would be almost zero. So I think given the fact that liquidity and some macro improvement and geopolitical risks kind of abating, we have seen again markets consolidating and probably moving a bit higher.
Mahesh, when you say a bit higher, do you expect another 5 to 10% up move from here, or do you think markets could scale up significantly higher from the current levels of 7,900 already?
Well, we would expect markets actually to consolidate. That's what our view has been, because we have seen that in terms of any significant change in earnings, we don't see that in the near term. And the fact that the numbers, also what we have seen quarterly numbers, have been kind of mixed bag. And more importantly, I think valuations are now, most of the large cap names, or even the mid cap space, are now reasonable or slightly higher than the long-term average. So given that kind of a scenario, I think one would expect markets to consolidate around these levels. But I think if global liquidity continues in the way it is, then I think it can even still move higher.
Mahesh, post the election verdict, defensives have occupied all the center stage, be it IT, pharma, consumer names. Now that macros are looking better, do you think cyclicals will make a comeback?
So we have been seeing this sector rotation all throughout the last 1 year. And initially, as I said, before leading up to the elections, the fact that cyclicals were quoting at a significant discount to their long-term average, and some hopes of recovery coming in, you see a big rally over in the cyclicals. Then I think some sanity check happened after the election results, and especially after the budget, and as the quarterly seasons came in. And defensives, which were continuing to show a decent growth, outperformed a bit. But I think going forward with a slightly medium long-term view, I think cyclicals should see further improvement more in their fundamentals as we move forward, and that should drive outperformance in that space. Also, our view is that interest rates, while it might not come down in the next 3 months, 6 months, but where inflation is headed, clearly it's in line with the RBI glide path, and that could mean some moderation in interest rates by the end of this fiscal year. So that should also aid cyclicals from a structural point.
Mahesh, you were just reiterating to as to how crude oil prices, coming down is definitely going to aid under recoveries. What's the sense that you're getting now about the OMC trade, which again we saw play out yesterday as well? Is it now reaching its, top end of the curve, or is there still money to be made? Of course, dependent on how crude prices move.
So the oil marketing company, especially the PSUs, have been outperforming more as the subsidies are coming down. So what would that mean is that the outstanding, okay, which is there in terms of receivables, that will come down. So that will mean a better balance sheet, lower debt and lower interest costs for these companies, which will improve the return on capital employed. And that's what I think the reason for re-rating in this stock. There is still possibly some potential upside over there going forward. But I think more importantly, I think if diesel or the petrol and diesel prices become market linked and the companies are able to price it, then the marketing margins can also improve for some of these companies. We saw some of the OMCs in the last quarter, the marketing margins really moved up because they didn't really pass on the cut in the fuel prices immediately. So if that happens, then there could be some scope for further re-rating even from these levels.
Mahesh, you mentioned that you are bullish on oil marketing stocks. So are you happy to own the HPCLs and the BPCLs of the world for next 2-3 years? Do you see enough earning visibility for next 2 or 3 years?
Well, I think most of the PSUs, I think it's slightly difficult to take a very long-term view, but clearly I think there is some change in the fundamentals what we are seeing, and given the fact that you will see some upgrade to the earnings, better balance sheet, I think there is some scope for a PE re-rating which is there. I think that's a trade I think which currently one would be looking at in these names. Going forward, okay, whether they will continue to really compound earning is a matter of in terms of how the capital allocation decisions are made in these companies. I think that will be critical.
Mahesh, the big hurrah for Indian markets is that finally domestic institutional investors have turned net buyers in Indian stocks. Do you think that trend is here to stay? And if that trend is here to stay, how will that change market dynamics?
So I think you rightly said domestic investors, especially in the month of June and July, have seen very good inflows into the mutual funds. And that's on the back of renewed confidence, especially post the elections. And a lot of investors who are waiting on the sidelines for the election outlook, they have come in. But the real big retail money is still now not really coming in a big way. We are seeing large institutional investors participating. The only good news is that the number of folios has increased in the last 1 month or so. Looking at the historically, the fact that domestic retail investors have moved out of equity markets in the last 7 years, and as a result, the equity as a percentage of household savings, which used to be at a peak around 7.5%, has come down to below 3%. It's around 2.5%. It's a historical low. So, and the fact that investments, the returns expectation from other asset classes, whether it is gold or real estate, and even from the on the bonds, okay, on the mutual fund on the debt side, because of the taxation structure, I think the next few years, I think you should see the retail money coming into equities, either directly or in mutual funds. I think should increase. And as the outlook for equities, as the macro improves and the returns, historical returns, what investors see, that looks better, I think that can only accelerate. What we have seen is that investors normally look at past 3-year returns in any asset class before they really come in a big way. And equities have now given good returns for the last 1 year, I would say, or even more. So going by that track record, I think in the next 1 or 2 years, I think we should see decent flows coming in, and that will be good in terms of balancing out their fire flows. So with domestic investors also participating, and FIs have always been positive, but if for some reason FIs pull out money because of global risk off, I think that would act as a balancing figure and stabilizing force in the market going forward.
I also want to see how some of these pharma names are doing, considering, we've seen year to date a great performance coming in from pharma majors, the likes of Cipla, Sun Pharma. They're all at life highs. And today too, that green continues across the screen, and this is pretty much the move not just across the frontliners but spread across the mid-cap universe as well when it comes to the pharma pack. Mahesh, how are you approaching pharma companies right now? Because like I just mentioned, across the board, be it mid-caps, small caps, or large caps, pharmaceutical names have given one very good returns. Is it time to profit take now, or would you stay put in pharma names because, their quality?
The pharma companies have, even the quarterly numbers which came in have been pretty good for the pharma companies. They have shown a growth anywhere between around 16% to around 22% in that range, which is probably the best in class across industries. And a lot of Indian companies are still having very good product pipeline, especially in the US generic space. And those opportunities, especially the first to file opportunities, acts as a kind of topper on that. And I think that outlook continues to remain pretty decent. And given the fact, while the valuations are slightly on the higher side, I think the sustainability in terms of earnings growth, and that too in somewhere in the high teens, I think make some of the pharma names pretty good, more secular and sustainable stories even from a medium to long term perspective, despite the recent outperformance.
Well, on expected lines, it's all about banks, and if macro concerns are subsiding, the first port of call is that you go and buy banks. Yesterday it was ICICI Bank, and today IndusInd Bank has appreciated on strong volumes, price volume breakouts there on your screen. Mahesh, is it time to be a contra buyer in PSU banks, because the NPA concerns, corporate governance issues, all of them are well documented. Even the Panwala on the street knows that PSU banks don't enjoy good corporate governance.
So PSU banks have been kind of good contra buys for the last, I would say, 3 to 6 months because of the fact that the asset quality concerns is somewhat, we are not hit a kind of a turnaround, we are not seeing a turnaround, but at least we have hit a bottom over there. And with the macro improving, the economy outlook improving, I think that should ease. But I think the real concern in the PSU banking space now is the kind of capitalization I think they would require. And that's an area I think which would still be an overhang on the PSU banks, especially the weaker banks, which would find it difficult to really raise capital from the public. I think the budget and from the government, I think we haven't seen any big reforms in terms of how they're going to really fund this. So I think unless clarity emerges, if they're going to really go to the market and raise money in these kind of conditions, especially when valuations are below book value, I think that would not really be good for some of the weaker PSU banks.
Okay, I just want to revisit some of the other names as well. While Adani Ports, of course, is seeing a second day of gains aside of IndusInd Bank, so a breakout coming in for Adani Ports too. But take a look at Tata Motors as well as the Tata Motors DVR. Now, these two have been significant performers. While the DVR continues to trade at a discount to Tata Motors, the DVR today is seeing some consolidation set in. It's lower by about 0.5% after the one-way up move that the DVR has seen off late. Tata Motors DVR currently at 346.95 thereabouts. Mahesh, this is turning out to be a very interesting story. While the DVR continues to trade at a discount to Tata Motors, what's the sense that you're getting? Is it time now to put fresh money into Tata Motors or the DVR? And where should one put money in, if at all?
Well, I think before investing in any particular company, I think one should look at the underlying, the main stock, okay, and what's the outlook on that. So if one is positive on Tata Motors, because of what's happening in JLR, and that's where the bulk of the valuation is coming, almost 75% of the value would be coming in from that. Then I think we'll prefer to be in the mainline stock. I think, well, DVR offers an opportunity to participate on the underlying, depending on where the discount is. I think historically the discount in Indian markets for non-voting shares has been on the higher side. People tend to equate it, what the discount is for non-voting shares in the other developed markets like US, which is between say 5 to 10%. But I mean, I don't see any reason why that discount should narrow down to that extent. Obviously, when the discount really becomes excessive, we have seen that going up to even 50%. I think that time there is probably a trade, okay, to play that the discount will narrow and play the underlying DVR. But I think discount will probably still remain to the extent of around 25% or so. And depending on where the discount is important, there could be some relative trade, okay, which could be there on the underlying non-voting shares.
Mahesh, Just how the oil and gas sector has got re-rated post-policy reforms and diesel deregulation, which is the next big sector where you're confident of a meaningful re-rating and policy initiatives?
Well, I think from a government standpoint, in terms of where we would expect some reforms or some policy initiatives, I think obviously it was one in the PSU banking sector is where we were expecting. The government has taken some cognizance in terms of reforming the PSU banks, but I think one has to see some concrete steps over there, and especially on how they're going to recapitalize some of these banks without them having to go to the retail market and do that. So if we see something on that front going forward, I think there is potential for a re-rating on that front. Similarly, I think in the power sector also, where a lot has been talked about, but on the ground we haven't seen any meaningful progress over there in terms of especially how to resolve the fuel supply issues, and also trying to reform some of these SEB, state electricity boards. So that's again a potential area where you could see a significant re-rating. There's a huge investment, which is required in the transmission and distribution sector. So some of these things, if they are addressed and there's a clear policy framework, then I think there is good long-term returns in these sectors.
Mahesh, what's the sense that you're getting about cement as a sector? Because clearly interest seems to be coming back to this space now, and more importantly, not the large caps, but mid-cap cement is the one which is really sort of attracting big boy investors. Do you like anything from the sector?
Again, cement is again a kind of an indirect play on the economic recovery, and that's what is driving the outperformance over there. We have seen in the last 2 months, the good news is that the cement output has been pretty good after a very weak last year. So that's positive news, at least from the demand side, though it's still early days. But with the clear thrust of the government on infrastructure development going forward, I think the demand can pick up significantly. But on the supply side, demand supply still remains kind of adverse. Capacity utilizations are still pretty low. So given that, I think in the near term probably you should not see any significant price increases in the cement sector, which could improve the EBITDA per ton. Having said that, clearly on the large cap names, the valuations are very reasonable or slightly on the higher side, quoting at anywhere between $150 to $200 per ton. Mid-cap cement is where still the valuations are reasonable, and that's where still some re-rating potential is there. We are kind of neutralish on this sector at this point in time, because especially in larger cap names where the valuations are. But clearly, as the broad long-term macro theme, as things improve, as demand picks up, we should see the profitability for this sector improving.